Hi, good evening or good afternoon. Thanks for joining us at this hour. My name is Wang. I'm the CIO of Private Wealth Management. And I'd like to start with a related personal story. You know, before I joined UOB Hian, I was a China fund manager dealing mostly with institutional investors, actually very big institutional investors globally. And I still maintain a line with those folks. Some of them do not invest in China anymore, unfortunately, but some of them still do. And many of them have come to me and say, today they found the Chinese SOEs, the most investable Chinese companies in China. And these are the same people who made a lot of money in Tencent, Alibaba, all the private companies were very much against the SOEs in the past. So you can see kind of a change of attitude. I thought that's interesting to share. And it's related to what we talk about today. I've been saying that July has been a critical month for China for 3 reasons. And so far, it's been kind of disappointing. We have the low base in terms of macroeconomic numbers from China. And now, despite the low base, we have some really disappointing data, especially on consumption. The Third Plenum just concluded today, I believe, and they're supposed to talk about, supposed to have, some policy announcements and etc. But given that this is mainly a political conference, I'm not surprised by today's post-event announcement, mainly focus on the Chinese Communist Party's internal politics. Of course, we can probably expect some policy in the next few days or weeks from that. But if you look at the rhetoric today, so far it's more political than economical. And we can talk about that more later. So net is net neutral. And I also talk about the upcoming China-Asia earnings has been very volatile. So the early estimate we saw was for 5% growth. Now it's turning negative because a bunch of Chinese Asia companies have pre-announced, and most of them pre-announced negatively, not positively. So that is also a big question mark for July and August when China Asia company or Hong Kong companies report their earnings. We will continue to monitor that and update you as frequently as possible on earnings. So what does that get us? We have high hopes for July and disappointments, not just in July, but probably your experience, my experience, show that we have continued disappointment with policy and continued weakness in real estate, in consumption, which is pretty much the norm these days, which I would also talk more about that later. Is there a change of view? Yes. We are becoming less positive and more cautious on China. It doesn't mean we are bearish, but we just need to be practical. And we need to watch out for the risk. That's why we recommend a shift to investing more the Chinese SOEs, similar to the story I just mentioned. There are 5 reasons why you should do that, and I'll talk about that in more detail later. In terms of the core recommendation changes, you can expect us to move more towards SOEs. Right now we have about 2 or 3 companies, but we'll be shifting more towards SOEs. Probably more than half of our China recommendations will eventually be Chinese SOEs, central SOEs. And today we are switching multi with China Resources Beer or CR Beer. Also talk about this more later. We are removing SMIC. Clearly, that with today's news, with the past tech sanctions on China, this company is having a big struggle. And we do not expect a turnaround anytime soon. And because of our cautious stance on China, we're removing the two ETFs, the two beta plays, CSI 300 and HSCEI ETF. But we do recommend investors keep using this MSCI China ETF listed in the US. This includes H shares, A shares, B shares, and US ADRs. So if there's one ETF, institutional investor investing, remember the institutional angle, the institutions absolutely love this ETF because it can do all China in one shot. So you still want a China exposure, this is the first ETF you should go to, the first ETF you should invest in, and this is also in our global all ETF portfolio. That's how we use this, that's how we allocate to China using this ETF. And then lastly, I'll talk about the US small caps, why you should consider, what are the risks, and how to trade it. I talked about earlier that for July, the most disappointing data is on consumption, not just retail sales, CPI, services PMI, consumer confidence, vehicle sales in China, very disappointing. So if you look at retail sales, despite the low base in June 2023, June 2024 was up only 2%, missing the estimate by almost more than 1%. And if you look at the 2-year growth, that's only 5%. Almost never happened in China. And that's why I scored the Chinese economy as a whole a 3 on a scale of 1 to 10. If you look at the nominal figures, it's mixed because consumption is weak and exports are strong. Consumption is weak, but manufacturing is okay, right? Stable. The manufacturing PMI is stabilized. But considering the low base, things are not as good as people think. So what is the conclusion? Is this just a 1-month phenomenon? No. So we have given China economy enough impatience and waited long enough for things to turn around. Obviously, things are not getting better, but things are getting worse. And naturally, when you think about, is this a long-term thing, a longer-term thing? It's not just a cyclical issue. And that's why I think the new normal should be defined as continuing macro uncertainty and the policy disappointments. The number one thing that comes to my mind is that there may be a misalignment of interest and a misalignment of views between the government and us. What does the government want may be very different from what we investors want. So I'll give you one example. Security is a big issue now in China. How does that work with growth? How does that work with economy? Or you can say security basically is economic security. No, it's beyond that. So naturally there may be some conflicts. And today's Third Plenum press release talk about reform. Of course, you can say reform leads to growth, but does reform always lead to growth? The China government always even tell you that the aging population is the opportunity, not a challenge. Really? Maybe they're smarter than us, but I don't see that. I don't see how reform will directly lead to the growth we see in the past, at least. Okay? Not to mention whether any real reform or not. And then we have this real estate problem leading to more local government problems because the decline in land auction revenue. I'm not sure you guys remember in our China tourism piece, we talk about the local government has a real incentive to promote tourism because they're losing land auction, the real estate land sales. That's why they need to look for other sources of revenue. That becomes a problem now. On the upside, on the good side, the local government may promote the tourism, but some local government just simply increase the fines, increase the rent-seeking behavior, increasing other forms of, like increasing the tax to make up the loss. Is that really good or not? I don't know. And related to local government is we also looking very closely at this LGFV, which I think is the weakest link in the Chinese financial system, not real estate, not the mortgage. In fact, people are paying the mortgages. And LTV ratio is controllable, very low in China. But this LGFV does present some real risk. It's not new. And most of the people I speak to, including people working in commercial banks, do not believe this will be a financial crisis because the government has plenty of tools at their hands to solve this. We'll see. And then lastly, of course, the U.S.-China relations, that's a constant topic. Look like Trump is going to win the election post the shooting. Is this also part of the new norm related to the SOE versus POEs, private-owned enterprise? 2 points from this chart. Number one, you can see that the industrial value add decline over time as the Chinese economy declines, the growth declines. So that's a secular trend that we have to live with, lower growth. On top of that, the SOEs, the state-owned companies in this cycle starting 2023, early 2023, the reopening, seem more resilient, have a very sharp rebound in terms of industrial value add. Why is that? Again, many different explanations. I think right now the POEs not just lack the ability to grow because they have financial problems, they have difficult obtaining loans, or they may be facing these sanctions by the US or the trade war, tariffs, all these things add up. So they're not doing well for sure. And then the other is the willingness. And that's evident in the fixed asset investment numbers by private enterprises. That's evident in the M2 and also the loan growth in China. As you can see, private companies just not willing to expand, not willing to grow, not willing to take more risk. But SOE seem to be fine and maybe even doing better. 5 reasons why we like SOEs. Why now? Number one, think about your worst nightmare when investing in China. It has to be the regulatory risk, right? So SOE at least does not have that risk or have very little risk. So the question I will pose is, remember the DD IPO? If DD is a state-owned enterprise, will they go against CSRC and go public in the US and thus cause this fiasco? Apparently not, right? So you don't have to worry about SOEs on that front. And they all have to seem to have some kind of stable businesses because they have enjoy some monopolistic positions in telecom, in banking, in defense industry, in these key strategic industries in China. Mostly, in some cases, all are central state-owned companies. That's why you see, in terms of volatility of the earnings growth, is much lower than private enterprises. The growth is lower too, but the volatility of the growth is lower. Now, what does that remind you of? It's our barbell strategy, right? So we talk about either you go high volatility, high growth, high return, or you low growth, low return, low volatility. So it seems to me that we have be able to make a match some central state-owned company may be fitting, not all, but I think a good number of these central state-owned companies in China fitting to our low growth, low return, low volatility basket with pretty high certainty. And then we talk about SOE reforms. I can give you another hour speech on this, but I'm sure it won't be worthwhile. Two things to remember from the SOE reform. Some things are real, some things are not. What's real is that all SOEs have successfully deleveraged from the in the last few years. Lower debt to equity ratio, China Telecom, Shenhua Co, a lot of energy companies are going from net debt to net cash. And then the other thing is new that we talk about this year is the market cap management is now a key performance indicator for state-owned companies, forcing them to either raise dividends or do share buybacks. Number 4 reason is the dividend yield. Probably no more convincing on that. There's some stats for you to consider. You trade the market today, you see how people are attracted to companies like China Mobile and PetroChina for the yield. And on top of that, the yield is even more attractive if you're a mainland Chinese investor, because when you trade the same state-owned companies, you are paying higher. The premium of A plus H is significant, and the discount make H share of central SOE even more attractive. And lastly is the national teams buying, which is part of our thesis on China put, that China has the pool of money set aside to support the market. And they tend to buy the index names, they tend to buy some SOE companies, though the index don't really contain a lot of SOEs as they want. But there's one company that you need to pay attention to, which is called the China Reform Holdings. It's part of the SASAC. The Chinese name is 国兴, 国资委下面的国兴投资公司. Yeah. So what they are doing is consistent with what I said earlier about the market cap management, SOE reform. Think of them as a sovereign wealth fund, but their only goal is to help reform the central SOEs, and the way they buy, the way they promote the reform is to buy up or support the central SOEs which they believe are doing a good job of reforming, putting the money where the mouth is. And there's a launch, the Bosera launched the ETF last week just on that, also sponsored by China Reform Holdings, tracking 50 central state-owned companies which they believe are doing a good job of reforming. And onshore in China A-shares, we already have these ETFs tracking the same or roughly the same central SOE companies, sponsored by who? Again, China Reform Holdings. So they're going to play a key role in supporting state capital and supporting reform, and try to use the capital market as a tool to incentivize the SOEs. On the core recommendation changes, this morning I shared a Hong Kong retail chat about how the rationale of us switching multi from multi to China Resources beer. We originally positioned multi as a consumption upgrade story. Obviously, that story may come to an end. And I also shared this morning that there's increasing correlation between liquor consumption and China's real estate sales. And it makes sense, right? When you have, if you're familiar with a real estate project, you can kind of see from beginning to finish how many dinners and banquets that need to be held, right, to complete the whole thing. Sometimes with local government officials, sometimes with real estate agents or whatever. So that historically has accounted for something like 20% of liquor sales, 20 to 25%. So clearly, with the real estate struggling, the liquor sales in China is also struggling, not to mention we have lower income, higher unemployment that may force a consumption downgrade. And not Multi is also not a central state-owned company. Remember the local government risk I talk about? Multi is also open to that. And CR Beer, we're adding this as not only as a central state-owned company, but also a consumption downgrade beneficiary. Beer is low ticket item, is more resilient, and whether Trump become president or not, whether there be another trade war or tech war, whether this reform in China will play out or not, people will still need to drink beer. It's not, again, it's not a high growth, it's not a sexy story, but it's a steady as you go, very stable, sizable market. China is already the biggest beer market in the world, and CR Beer is the leading player, not Qingdao Brewery. Again, most people will think about Qingdao. China Resources Beer is the #1 in China, and they also have an interesting partnership with Heineken to distribute, to licensing, to resell as part of premiumization. That's why for this company, we'll see a single-digit top-line growth, but you have double-digit earnings growth because the margin expansion from premiumization, if you look at the valuation of this company across the globe versus other beer companies, is very cheap. The only thing that you may not like is not a high dividend paying company yet because they have made some acquisitions. It hurted their cash flow last year. But starting this year, they're going to resume strong cash flow. And as you know, the food and beverage is a very good cash flow business. And that's why we expect them to increase the cash flow and then later increase the dividend payout and eventually also increase the dividend. But near term, don't count on the dividend. This really is about steadiness, safety, and some growth from premiumization. Lastly, on US small caps, and you probably heard this from many of the brokers or even your clients or the news. First of all, I want to show to you how extreme this small cap outperformance has been. This thing started on Thursday last week, and it lasted 6 trading days so far. In 6 trading days, S&P small cap outperformed S&P large cap, S&P 500, by 10%. And that is perhaps the biggest reversal. We call it momentum reversal in the last 6 years, 7 years. If you look at previous reversals, it did get to 12% and 48%, but it took a long time. So 2 points here. Number one, momentum reversal seems to be happening. Number two, we have a very fast reversal. That's where, even though we do think that you need to think about buying some, but be very careful with how quickly this reversal already happened. Again, look at the numbers on the lower right. If you use the reference from the previous reversal, it's only 12% outperformance. And we already have 10% outperformance. So you can say the further upside in terms of small cap outperforming large cap may be limited. But we do want to highlight this to you because there's some fundamental reasons. This is not just the technical reversal. There are fundamental reasons that why this is happening on Thursday also. Why on Thursday, not on Friday, not on Wednesday? Last Thursday, you have weaker than expected CPI, leading market to raise the expectation for Fed rate cuts. And guess what happened? M7 stocks were down a lot, and S&P 500 was down 2%, or something like 1 to 2%, while the small caps were up. So fundamentally what the market is telling us is that rate cuts are good for small caps, right? Why? Now, if you look at the sector bias, what does small cap have and what does small cap do not have? What they don't have, obviously, is the M7 and the big tech, but they do have a lot of financials, industrials, and real estate. And also, if you look at the net debt to equity leverage ratio in these small caps, are much worse than large caps. As you know, all the large cap companies are net cash, in fact. So fundamentally, it does make sense when the Fed cut rate in September and Goldman now expect in July. When that happens, yeah, fundamentally, these companies will benefit, and small cap is right down the alley. So fundamentally, I think there's an argument to look at small cap. And lastly, also, whether you invest in M7 or S&P 500, nominally, information technology accounts for 33% of S&P 500, nominally. But as I told you before, the sector classification is not correct. 4 companies here, Amazon, Tesla, Google, and Meta, are not classified as information technology. Beats me. So if you add those companies, that's 43%. So even if you just invest in the large caps blindly using S&P 500, you have 43% exposure to tech. And with the tech going on so strong, naturally you need to think about how do you mitigate that risk. So that's another angle that you should think about small cap. If you already have the M7, if you already loaded up on big tech, big cap, S&P 500, well, maybe sometime it's time to moderate. Okay, we're not saying to shift everything into small caps. Allow me to be clear. I'm not saying shifting everything to small caps, but it's time to consider. And like I said, it's a trading thing. It's not our core recommendation. We're not recommending individual small cap stocks. We have no insight on that. And like I said, in the very short term, this reversal is too much already. So we can wait and see, right? For the next one, I think may very well the small cap have a pullback because it's gone up so strongly. And in terms of implementation, our OET, the toolkit, in our global ETF toolkit, we have IJR, which is S&P small cap. The reason we pick that is because to maintain the consistency, right? When you do small cap, large cap, you want to do long short, you want to do more fancy stuff, you want to do a detailed analysis, S&P versus S&P, IJR versus SPY. But I understand Russell 2000 is what everybody talk about, what everybody trades. As clearly you can see the last few days, the volume has picked up tremendously on the Russell, not the S&P. Okay? S&P is more for institutional. Russell is more for individuals. And when I say, anybody say small cap, the first thing come to mind is Russell, right? It's just a brand thing. Okay, you can do both, up to you. The composition of Russell 2000 is very similar, that it just has a higher expense ratio. Okay, I'm going to stop here and take any questions. If you have any question, please use the chat window to type, and we will answer them in the order that they come in. The first question is on won't Chinese consumers refuse to consume much affect the business of Chinese resources beer too? That's a good question. But there's a lot of loaded words here. If I may, to clarify the word, what do you mean by consume much? I view beer as a consumer staples. So I don't think it's a must-have item, but it's pretty close to it for people who have a habit of consuming beer. It's like people have a habit of drinking milk, right? Not everybody drink milk, and no one has to drink milk, but people just have a habit of beer consumption, not just in China, but also globally. So that's more defensive and more defensive to the consumption risk. And one thing I also mentioned related to that is, it's interesting, we are seeing this with US consumption as well. The US consumption, as you know, is not doing that well. That you have overall consumption coming down and the consumption upgrade not happening. But we do have something called affordable luxury. We see that with Starbucks, and we increasingly to see it with many other consumption companies around the world. What that means is that you're not going to see people buying a Ferrari and spend $100,000 US customizing the Ferrari. But you're going to have people buying a $10 coffee and willing to pay up $3 more to get something extra to please themselves. You can say that's also a consumption downgrade. So beer is perfect, and CRB is perfectly positioned for that, right? Guess how much a beer costs in China? Whatever you pay what? 10 cents, 20 cents more per bottle to get something that at least make you feel good. That is a good business. Okay. So what would you suggest if you were already holding a Hong Kong stocks which are down badly? I don't know what you hold. The reason I say stock picking is really important at this point is that some stocks of your portfolio may go back up, some stocks may not. It's not about waiting. Some stocks just may disappear for some reason. And we've seen that in China before. Delist or maybe even bankrupt, right? If things go down like this. So hard to say. One thing that's not SOE, and we decided to keep in our portfolio or core recommendation, is Alibaba. And there's a technical reason also, because they're going for dual primary listing next month in Hong Kong, possibly followed by southbound trading in September. That would be a big deal for Alibaba, so let's hold on to that. At least wait until after that and see whether, there's any upside. So again, if you, hopefully, back to your question about what stocks, what to do with the stocks in portfolio, think about what I just said earlier. You have a consumption downgrade, your consumption slowdown, your manufacturing might be doing okay. What do you do with the portfolio? Does the stock really benefit from that? And there are some stocks may capitalize on that, right? So it really depends. It's not all that bad. I mean, it's just about change. Just quickly on PetroChina, we made a lot of money on PetroChina because not because of oil is doing so well, because China has an energy security agenda. Of course, PetroChina will do well. They want PetroChina to do well. If China want to make energy security as the #1 security, right? So again, opportunities like that exist, but it's not going to be as many as before. Okay, instead of switching to small caps, will non-tech big caps be more viable? Do you have any favorable sector? Also, really good question. We have not done any research on the non-tech large cap. The only non-tech large cap is Berkshire Hathaway in our portfolio. So please, let me show you my slide here. So when you go non-tech, I suggest just go as dumb as possible, as boring as possible, as predictable as possible. Don't try to be fancy, because you already have your fancy tech, the high volatility NVIDIA, high risk, high reward there. So here's our US stock recommendation. Berkshire Hathaway is one of the names I mentioned. And we also like consumer staples name like Walmart. And we like energy, which is the XLE ETF, followed by Occidental Oil. I can go through details any of these if you like. But back to Berkshire Hathaway, I know a lot of our clients like financials, like banks, like insurance companies. And you notice that we never ever talk about that, either in our daily ideas, weekly ideas, or any of the Wealth Monthly. Because I personally have a view against those companies, because I believe the banks are intransparent, have tail risk, things that they don't really can control. But the exception, if you do like financials, if you do like insurance, the only company that I invest in is Berkshire. So I would hand it over to Warren Buffett to manage that risk for me. You don't have to, or maybe JP Morgan. That's it. That's two names. Everything else, I would say it's a little bit tricky, okay? But not tricky for Warren Buffett. He is an expert in it. So just put money in Warren Buffett if you like financials. Berkshire Hathaway essentially is an insurance company. And I trust Warren Buffett more than JP Morgan CEO. Okay, what would you suggest if you are already holding Hong Kong stock? Okay, we answered that already. And what are the non-tech stocks seen rising, or maybe not for me to answer? You can do the stock screen yourself. You mean rising in terms of fundamentals? Again, non-tech stuff, our recommendation is to go with the boring stuff. The best thing for those companies, you guess what? Is no change. I don't want any change of those companies. I don't want to see any change of the McDonald's. I don't want to see any change of the Walmart, okay? The less they change is better. That's their business. Don't try to be fancy. And I think everything else, we will look at it. Healthcare, for example, I'm sure there are a lot of interesting opportunities, but we don't have any insights. Okay, TSMC just released earnings reports today, and it's very good results. U.S. big tech's pre-market price has gone up 1 to 2%. Generally, do you think the big tech trend is going to pick up again from now on? It's hard to say in the short term. So our recommendation, we have 4 recommendations in our U.S. stock selection related to the other end of the barbell, which is the tech. I just talked about Warren Buffett and Walmart, the boring stuff, right? So the more exciting things, you have to hold them for the long term. When I say long term, 1 year is, plus is not that long, but you know that's a minimal expectation you should have. On top of it, it doesn't mean you cannot change it or you cannot adjust it, right? When I say change the position size. So when NVIDIA pre-split went up over $1,000, now over $100, we recommend investors to take profit. I'm not sure any of you guys took profit. The one who sold some probably hate me now because it went up to 135. Okay, I can never really pick the top for you, but you still have the remaining positions, right? So Tesla too. We did not recommend Tesla, but you know, with the stock rising, we've been telling people to take profit. I think the stock is well above its fair value. It definitely has overrun, and without all the robotaxi and the other things happening, we just need to be cautious. So I'm not sure I answer your question. Take advantage of these, maintain a core position. I don't think yet. So yesterday's news was on what? Biden possibly having more tax sanctions on China, semiconductor, right? The whole semiconductor space went down. If Qualcomm goes down, I understand. Qualcomm have a big exposure to China. NVIDIA goes down, I don't know. Does NVIDIA really have that much exposure to China these days? No. So of course, to me, it's a buying opportunity. But again, it's going to differ from person to person. Some people already loaded up on NVIDIA. I would not recommend buying. But if you have not bought NVIDIA, and you don't have NVIDIA portfolio, it may be a good time to buy it for the first time to build up a position. I don't think any tech sanctions on China is to break the AI trend, right? I don't think so. So going back to Broadcom, yesterday we're down 7%, NVIDIA down 6-7%. I think it's a good buying opportunity. And another question on last night's tech pullback. Let me see if I can expand this. Okay. Yes, so I got at least 2 questions on last night's tech pullback. And we as PW Research will try to comment on those as frequently as possible, so we are stay on top of it. There are days that you have these major movements like Thursday's small cap outperformance versus large cap. It's a short-term thing, but we think it'll lead to a medium-term, longer-term trend. That's significant. Last night, the tech pullback, I look at it, it's just a one-day thing. I don't think it has any meaningful implication. Even if you factor in the Trump winning, it just does not make sense for the tech to go down like this. So you can view this as a non-event. Fundamentally, it's a non-event. I think just because the market got nervous, the stocks got overbought, of course you get these type of volatilities. So I will not read too much into this one-day movement, but there are days that these movements does mean something. I will make sure to talk about, make sure to highlight it to you, and make sure to give you the actionable ideas. Last night seemed mostly the technical correction, and that's why I think, for ones that do not have U.S. big tech exposure, it's time to buy. Cement counters, no idea. What are your views on Baidu, Tencent, and Alibaba? So I talked about view on Alibaba earlier. They're buying back shares, which is good. But here's the difference. The reason also we don't like Tencent, we talked about this before. It's about different expectations for different companies. When the state-owned companies buy back shares and pay dividends to try to prop up the stock price, I understand. Because the state-owned companies, they're not the smartest people in the world. They're not supposed to be smart. Their business runs like a monopoly. There's no growth, okay? So, the best they can do for SOEs is to do that. And I actually like that in today's China environment, given how sophisticated it is. You want the simple companies doing simple behaviors. Back to BAT, it's not acceptable. Let me say that again. It's not acceptable for them just to buy back and increase dividends to support the share price because investors have growth expectations, right? So if I come to you and say, oh, buy Amazon because Amazon buy back shares, that's not acceptable because Amazon is also doing many other interesting things like AI and data centers and cloud computing. Is any of the M7 company buying back shares and not doing anything? Name it. No. So what's the Chinese internet? That's what I'm not happy about. That they're just buying back shares. What has Tencent done to enhance the shareholder value besides the buy back shares and raise dividends? Alibaba's done a lot, even though they made a lot of mistakes, but they never stop trying. I can give you a long list of things that Alibaba does. So on that front alone, I will write off all the other internet companies right away. We removed Tencent from our core recommendations at the end of the first quarter. I will never look back again for a long time. Do you think it's a good entry point for what? I don't know what the entry point means for US stocks or for Chinese stocks. And would it be a good time to invest in property counters? No, never. Not in Chinese companies. Never in Chinese company property counters. Never a good time. I will never touch that with a 10-foot pole. The reason being that the highest Chinese property return on equity was ever gone in 2018 at 30% ROE. And today everything's going towards the norm, and maybe even below norm. The global norm is 8 to 10% ROE. And Chinese company localized going to 5% ROE because it will be dominated by SOEs, and SOE can live with 5% no problem. For private companies, 5% is going to kill them. So this is a bad business to begin with. It's no longer business anymore. The property development is no longer the business. It's a social thing. Okay, so no one going to get money, make much money out of it. And you can say we were lucky that the private developer makes so much money before. Why they have 30% ROE? Because they have high margin, high leverage, right? Look at if you think about the DuPont formula, high leverage, high margin, high turnover. And what's happening now? Everything's the opposite. Low leverage, low margin, and low turnover. Do you want to be in that sector? Okay, you have a target price 160 for, I do not cover BYD. We do not offer target prices. Please refer to our analyst Ken on that. And I obviously not the best person to comment on BYD. And it's nothing to do with our core recommendations. Let's focus on that if possible. Is the X hand or X pen disappear and hold a way to go up? Well, I assume you're talking about X pen, not X hand. X pen, the electric vehicle name. I hope I'm right. So on that front, yes, I'm a bit worried about what's happening here is we may have a solar industry crisis in 2008 in China that's brewing in the Chinese EV industry. And I expect everybody to do terribly, but there will be survivors. I'm not sure, I don't know expert enough to be a survivor, but I can tell you BYD will be a survivor, even though, it has a lot of problems as well, because the scale, I think they will survive. So for that front, I will use the scale as the main indicator to see which ones will have a higher chance of surviving. Things are not looking too good. Actually, things are looking terrible in China. I'll give you one example. The vehicle sales in China in June, I think, was down 4%. But the reality, if you look at licensing registration, is much worse because the actual sales is not as high as stated. The Statistics Bureau only look at the sell-in, which is the minute the car, and BYD too, when they report sales is when the car leave the factory and go into the dealership. That's when it's counted, so it's overstated. It's not the final sales. The final sales is much worse. Any thoughts on Baidu? We talk about the Baidu, same thing. Baidu, you know why people didn't like Baidu? It's the lowest growth among the before this hype on the robo-taxi. It's the lowest growth internet big tech Chinese companies, and their earnings growth is barely in line with the Chinese GDP, barely in line. Where even China Mobile is growing above GDP, like in 1 year. So that's no go. AI no inside. AI falls into one of those things in the middle. The first, if you like insurance, Berkshire Hathaway first, and then you think about something else. Meituan, yes. So Meituan, Alibaba, PDD, all the e-commerce retailer, online retailer names, online services names face the slowing consumption. And I shared this with our Hong Kong sales 2 days ago, where there's a major discrepancy in the reported e-commerce sales. And our analysts told us that because the government made some adjustment. Okay, I said, then the government's always right. We just go with the government data and everything will be fine. But there's a major adjustment in e-commerce sales. The real e-commerce sale this year is down, not up. If my math is correct. So there's a lot of fudging the numbers, and we don't want to go into details but clearly I said earlier, July is a turning point. It's a key month where we see another step down in consumption, not step up, another big step down in consumption. That worries me, and that's the reason to get worried about Meituan and Alibaba. No comment on Zhengwei. Apologize for that. When I say small cap, is the small cap US. Allow me to be very clear. Small cap US, not small cap China or Hong Kong. I hope I was clear in my communication. And US intends to reduce high-tech shipments to China will begin to affect US semiconductor company earnings. Do you think such negative effect will make US rethink allow more exports instead of curb them? No, I don't think so. I think the bulk of the effect is already over, right? Which companies, the Xilinx, which companies are going to have another major downside to earning because of China? NVIDIA clearly disengaged from China, decoupled from China. And the Broadcom, I don't think that much China exposure. Gary, any other new incremental negative impact on US semiconductor company? I really can't think of it.
Mostly on like ASML applied materials and like longer.
Yeah, maybe semiconductor equipment companies, but we have not done enough research on that. It's not on our recommended list. It's not even on our radar screen. I think if you want to make money, stay with AI semiconductors. The top two are NVIDIA and Broadcom, not AMD, not Intel, okay? NVIDIA, Broadcom, very little China exposure, a lot of AI exposure. So maybe we can search for ETF that tracks the ratio of DJI over NASDAQ. Yeah, that's an interesting idea. Yeah, definitely, we could. Unfortunately, the Dow Jones is not as popular as anymore. People don't really trade them. I don't think people trade that much. The futures, the most active is still S&P. And by index construction, Dow Jones is just not a solid index. It's a price weighted and it's only 30 stocks, and there's no reason why only 30 is 35 or 40. So, but that's an interesting idea, yes. But back to what I say about S&P. The reason I do like S&P because a lot of institutions, including hedge funds, are doing this. Using this, right? So I can clearly see people long the S&P ETF, small cap ETF, and short the S&P index futures. That's a perfect trade. No basis, not no basis, very little basis risk. And I used to buy hedge fund too. So as opposed to if you do too long, let's say Russell 2000 and short Dow Jones futures, then you have a lot of explanation to do with the boss. It's like, why two different indices and what is the mismatch and how these indexes are constructed? Is it really consistent, and what are there any overlaps? And there's a gazillion questions you have to go through, and these are real issues when you do a long short trade. So my recommendation for do a long short trade, right, is to do the IJR, S&P core small cap, and short the S&P 500 index. Perfect. That's a perfect trade. You don't have to lose sleep overnight about the index mismatching. Hope that makes sense. And then view on Japan semiconductor outlook, no view. With impending interest rate cuts on material stock like copper and aluminum buyback viable at the current level. No view on commodities other than gold. Our gold traders work very well. And opinion on Ping An. Yes, I already talked about the financial systematic risk. And Ping An has a lot of real estate exposure. It's not going to cause a problem in the short term. And you say it's a market leader, it's a big company. For big companies, these problems will surface over time. For small companies, it can happen overnight. In fact, economists just reported there's some 50 small Chinese banks disappeared overnight because they have problems, just suddenly blow up. And they were absorbed by big banks. Because big banks and big insurance companies, they have more ability to absorb these type of losses and shocks. So for now, I think Ping An is not facing any crisis for sure. But I just don't like the fact that you have to live with that for the next 2-3 years. You constantly think about or worry about their real estate exposure, right? So my view, maybe I did not communicate today clearly, is that the new normal is all this implication from real estate that's happening to us now. It's a delayed effect. People think, oh, real estate is maybe getting better, and then we're all fine. No, there may be a lingering effect or a lag between the real estate problem and then consumption, right? I talk about why consumption is a problem now. Why consumption wasn't a problem 2 years ago when real estate was also having a problem? Because there might be a lag. If you look at consumer confidence, it's been low for a long time. When it's low long enough, it be low for a couple quarters, fine. But it's low confidence for 8 quarters, it's a problem. Ping An story, same thing, that if this real estate problem continue to exist, Ping An can probably sustain, I'm just playing numbers, I don't know the exact number, but Ping An probably sustain 2 years of real estate fallout, 2 years. Now, if it added 1 month, 6 months to that, it could break it. Okay, it's the last straw that break the camel. So the timing is also important. Don't look at just how relative things are moving, how long this thing has lasted. Real estate, not prices, the real estate weakness has lasted a long time, and that's worrying to me. That's already playing to consumption and confidence, and potentially, like I said, financial systematic risk. It's not about how deep the real estate corrects. It's what happened that lasted for longer than we expected. Aging population, yes. Benefit company like JD Health. I don't know JD Health. I don't see any benefits to anybody. In fact, one of the disappointing things from the Third Plenum and from all previous China's policy, official policy announcement, like the Congress or the Financial Works Conference, no one mentioned about the population crisis. Even Korea now spoken publicly about a population crisis. This is by far a biggest long-term problem for China. And the Communist Party are not addressing it because they're so smart and they're so effective that they can solve it sometime later. So let's trust them that they can do the same thing to solve those problems, like how they solved COVID. Okay, great. We're almost at the hour. Anything I missed so far? No. For anyone who could not join, or your clients could not join the call, we will save the recording. We'll also send out the PPT. By the way, this PPT is compliance approved, can be distributed to clients externally. I want to thank everyone for joining again, and have a good night.